Welcome to the Dividend Talk podcast, episode 168. Third quarter earnings in full swing. Whether you're a seasoned pro or just getting started, Dividend Talk is the place to be for insights, analysis, and unsalted advice on how to make the most of your money through dividends with our own unique European flavor. Oh, and don't forget to subscribe to our podcast and join our community on Facebook at Dividend Talk. See you on the inside. Hey, European DJ. Another busy earnings week. What do you think
Oh
about
yeah,
that?
yeah. It's really becoming fun now, right? Because the stock market just continues to go down, down, down for the most of the stocks in our portfolios. So I would say, as dividend growth investors, we have had a good last 2 years. Most of us, I would say, if you had some energy stocks in your portfolio, but the last few weeks, it's really, coming nicely down. So great buying opportunities. So now it is really to how you say it, to separate the chaff from the wheat, right?
Yeah,
By just having a good look at those earnings of those companies that you're really convinced about. Do a double check on their balance sheet. Do a double check that they are continuing to grow, and if so, you know, buy with conviction, right? So this is why this quarter is also a bit more special than the others, because it's been a while that we have seen such how is it, turbulence in the market, not triggered by a black swan event or something like that, like a bank suddenly collapsing. This is really like, I think, interest rate infused sell-off, because if you look at the interest rate at the moment for the 10-year bond, I saw a picture this morning actually that it is higher than the Greece
wow,
10-year rate,
wow.
and that was also funny to see, right?
Yeah,
So yeah,
it's
because people have now other income alternatives. Finally, for many people, I like specifically non-dividend investors, and we get this question a lot, right? It's like, why are you not investing in the 10-year bond when it gives you, I don't know, 5% or something like that? Well, because it doesn't grow your dividend. Yeah, and if it goes to 7%, the bond prices go down, so you will actually experience a loss. So you will need to hold your bond, specifically the long duration bonds, for quite a while to recover your
yeah.
your coupon all the time, right?
It's a bit of a crazy market out there. It's like interest rates going up. A recession looks like it's been priced in at the moment. Oil is going up and up, and then you have tech stocks over there on their own little bubble, just doing their own thing as if nothing is happening. Like they're just still plodding along, like there's nothing going on in the market. It's so funny to watch this market. It's so confusing to get a handle on what's actually happening. But
Yeah, yeah.
that's the beauty
That
of it. You can't predict it.
exactly. And guys, remember, it's not a stock market, it's a market of stocks. So if you now find those high quality businesses that you've been waiting for, maybe some of them started to be priced to really start nibbling in a little bit, right? And that's the interesting thing for me in this market, which also makes it a bit more difficult because it requires a little bit more due diligence, a little bit more homework, specifically during this earnings seasons. And you and I have also a very busy job. We are launching really busy on the Dividend Growth Compass newsletter and service, of course, as well. But now, I'm not saying that we are seeing a bottom. I mean, if we really go into a recession and there will be a black swan event, of course, it can go much further. If you zoom out, we're still near the top of stock markets historically, right?
Yeah,
But it really feels more exciting than other seasons, let's say.
yeah. I agree. And interestingly, we did ask a question on the podcast last week, and this could affect companies. Obviously, if we have a recession, if we have interest rates keep going up, as I know the Fed are after still have a hawkish stance on that. So we did ask people, do you sell directly after a dividend cut? And interestingly, 91% of people said no, they don't.
Yeah, that's maybe it's because they listen to the podcast, because we are also not direct sellers after a dividend cut. Because what most important for us, I guess, and for many of them as well, we are dividend growth investors with focus on growth. Yeah. And we understand that sometimes a company, like we saw with Shell, had to do it just, and we already priced it in our own minds in there that this would be a likelihood when making the investment decision, right? But I think, I guess it's with most of the people. It's like once they cut it, do your homework. Yeah,
Yeah.
do your homework. Is there still future for this business or not? What I would like to say, like based on empirical data that I read the other week, like most of the times when a dividend gets cut, so like dividend cutters, they underperform the broader market.
Yeah.
So and we see this as well. Like we see it with AT&T, we see it
VFC.
with yeah, VFC. We see it also with Medical Properties Trust. Usually, it is because the company is broken.
Yeah.
Yeah, and that really needs that should probably be the main question after this. So actually, the minority that voted yes might actually, if you do this consistently, might actually have a better strategy to this, right? If you look at empirical data.
Yeah.
Just cut your losers straight away.
Yeah.
For instance, if 3M would cut now, you could argue like, is there really much more left to go down for this company? But that's what people also probably thought around AT&T. It's probably also what people thought about, I said, well,
Do you
some of the others, let's say.
do you ever hear the phrase that they're too big to fail? I think that's what a lot of people think about someone like 3M. They're too big to
Yeah,
fail, but that doesn't
yeah,
mean it won't happen. So yeah, you're right.
yeah,
It's super important to know actually even beforehand, because the signs
yeah,
are always there. The
yeah,
signs always point towards, like, Medical Properties Trust, that was
yeah,
coming. VFC was coming.
yeah,
Um, the signs are always there, so you probably should do your homework beforehand. And
yeah.
actually, if you are convinced the dividend is cut, maybe it's better to cut your losses before the dividend is cut.
Yeah, because hardly ever the dividend cut comes as a surprise. We
No,
have seen it with WP Carey. That was more like a surprise. But most of the times the company has been struggling already and it was up in the air.
yeah, yeah. WP Carey is a reset, not a cut. it's,
Yeah.
it's a
Well,
funny play on words.
AT&T called it, we are going to put a competitive dividend. Yeah.
Competitive dividend.
Intel
Yes.
also called it at a certain moment a competitive dividend.
Yeah. Okay, this week we will ask a question again, a poll around earnings. So it'll be interesting to hear your answers on that one. But speaking of dividend cutters, I'm going to dive straight into the news of the week. And again, Walgreens is in the news, and again, it is not good news. These guys just can't catch a break. We know that they're heavily involved in the opioid litigation, but there was also litigation around their Rite Aid merger that didn't take place. So a group of investors got together and they filed a lawsuit against Walgreens because they felt that Walgreens downplayed the antitrust scrutiny from US regulators, which ultimately led to the abandonment of this merger. So the merger didn't go ahead. Walgreens subsequently bought, I think, around 42% of Rite Aid's existing
Yeah.
stores for about 4 billion or so. And Rite Aid have now filed for bankruptcy. So it's coming all off the back of that. And Walgreens have now agreed to settle 192 million to these investors. I mean, in terms of the overall structure, it's not a whole lot of money for Walgreens, but when you think of the opioid litigation, you think
Yeah.
of everything that's going on there. It's just more bad news. Their stock price has been absolutely pummeled and hammered. And for me, this is a classic case of a company that is set up to cut their dividend. Honestly, I can just mark my words. This time next
Yeah.
year, I think they'll be after cutting their dividend by then.
Is there anything positive around this company?
At the moment, it's hard to see. It's hard to see. But
Yeah.
I mean, I find it so bizarre. You've got two companies in America that are quite big, and they got Boots, obviously in Europe, that does very well. So they have lots of good things, but they just can't seem to manage it right. There's just
Yeah.
problems all over
There's
the
just
place.
probably poor management in the
Just
end.
it boils down to poor management, in my opinion.
But for me, they were done already in my mind when they invested in Terrenos, when I read the book Bad Blood. And then when I heard how they were making decisions, I felt like, well, if this is management there, then yeah, this because what it looked like, this company is desperate to find growth, and the ego is so full there in the management to find growth. But and I think they're overstepping a lot, and well, yeah,
That's the problem. It is a sign of desperation, and look, they're trying. You can't fault them for trying, but do management really know what they are doing? And
yeah.
that's the ultimate question. And at the moment, it's hard to it's hard to point out too many positives about the company. So
Well, I hope that one of the board of managers and the board of directors is listening and maybe would like to come on the podcast and explain themselves.
yeah, it'd be great. That would actually be nice.
Yeah,
We could ask him some nice questions actually.
yeah,
Um, and a little bit more lighter news about Amazon. And I don't know why, but they're going to launch drone deliveries in Italy and UK from next year. I know they have it in America. I think it's in California at the moment, California and Texas. I don't know how that's going, but it's such an interesting concept, isn't it? Like a drone, you order on Amazon, and a drone
yeah,
will pick it up that day. It's the
yeah,
same day delivery and deliver
yeah.
it to your house. I think that's incredible. I'm raging that it's the UK and not Ireland. Ireland's obviously too small, but it's interesting that they picked Italy and the UK as their two test cases in Europe.
Yeah, actually, yes, because you would think of specifically when you think about Italy, it's quite a large country, right? But I assume that this is mainly in urban areas, I guess.
Yeah, possibly. Yeah, it doesn't state where, but it's
Yeah,
they must because I know in the UK they obviously have big fulfillment centers, so they must
yeah,
have a big presence of fulfillment centers in Italy as
yeah,
well. Otherwise, that's how it would make sense to do same day delivery. It's not going to go to
yeah,
Germany and pick up something and deliver to
yeah,
Italy or
yeah.
something like that.
Yeah, it will
So
be really interesting. I have no experience with this, right? I'm just wondering, like, okay, so I'll leave the box on my yard or on the doorsteps, and then, yeah, because well, is there then more theft with this? How does
that,
this
that's
work? Because you see in America that I think they have it quite advanced, right? That they with Ring or something like that connected. So yeah, interesting that's coming here as well. I think it would be difficult in an area where I'm living with all the power lines above the street. Yeah, and all the trees here. I wonder how a drone would navigate here. But
it's
yeah,
that's not as difficult as you think. I have to fly a drone every week at the same time. We're doing an
yeah,
expansion in work, so we're doing a time lapse. So
yeah,
a driver. We've the same. We have lots of different power lines, but you'd be surprised. Now I have a small drone. It's not a big drone for carrying big boxes, but
yeah.
I'm sure it would. I'm sure it would navigate.
Nice, nice,
But
nice.
my worry would be like theft. I just
Yeah.
it's a tough one to deal with. Anyway, let's dive straight into earnings. We've got a lot of earnings. A lot of European companies don't do full earnings. They do what's called a sales update. So
Yeah.
we'll try talk through maybe a few of these throughout the show. So do you want to do the honors and
Well,
pick?
I think let's start talking maybe about L'Oreal really quickly, which is the sales update. And L'Oreal was the focus point of our very first newsletter, right? And there
Yep,
were two conclusions there. China is really pulling the company forward and their luxury division.
yep,
Yeah. And those have been the two underperforming categories this quarter because luxury only grew 3.2% like for like, yeah, and reported minus 3.2%.
yep,
And North Asia declined like for like minus 4.8% and reported minus 15%, which is really interesting. So you would think then like, okay, overall sales is down, but then if you look at the group sales in the third quarter, still 11% up. Why is this? Their other very big consumer products unit grew by 13%, but this is also now their largest business unit. Yeah, so they almost single-handedly push the whole sales up, and this is actually quite surprising if you think about it. I mean, this year they have been just doing well, but historically they were just flat. Yeah,
yep,
so they really got a bit of a swing there, and the same with Europe. Europe is pulling the company forward at the moment because it became again, or it is again, the biggest unit by region, and North Asia has been flat just this year.
Yeah.
Very interesting to see this, that if another division that has been for 10 years pulling the company like with rapid growth, let's say really being the growth factor, now having a bad year, that suddenly Europe stands up. I find this very, very interesting, like to see these dynamics. While we are talking here about inflation, how you say it, a possible recession or already a recession in Germany, and that the company is then still being able to make all this money here in Europe. Very
Yeah.
interesting, very intriguing.
It is, and when you think about it, like if you're on the board of management there and you see China slowing down, I wonder how they do they have a preconception beforehand? Maybe at the start of the year, is Europe going to be our focus this year, and so on?
Yeah,
Because it's, I mean, this is no fluke, as you said. Over 9 months, Europe has grown 17.6%, while
yeah,
North Asia has been pretty much flat, 1% growth.
yeah,
So they must have some plans, or they must be pushing something in Europe that they haven't done before, which is
yeah,
driving this growth. But it's an interesting dynamic, and it's the power of a company like that is so diversified that if one region is struggling,
yeah,
another region normally isn't, and they're able to balance the two. But
yeah.
it
It
also
just
shows
shows
good
excellent
management.
management.
Yes.
Yeah, excellent management, and then also they keep on acquiring new brands in their portfolio, which they are also. I mean, this is what this company is, right? It is organic growth, but also a lot of growth by acquisition, because they can buy the smaller brands and give them and let's say sell it at scale. Yeah, and this of course very profitable for a company like L'Oreal.
No.
Hey, look, you get the company now 380 euros. The growth, how you say it, is around or between the my baseline case and the optimistic case that I did when I did a dividend discounted cash flow there, and I had it at 320 euros estimated. So it's 380 euros. It came quite a bit down this year, already just in the last half a year, 14%. So I bought, I think, one share as a token of appreciation not too long ago, around 400 euros. But yeah, consider me a buyer at around 320, 330, let's say, if it continues to decline like this.
Yeah. Nice one. I have a couple of quick sales updates as well. The first one, this is just a short one, is Excel Lux Optica. They make obviously all the branded glasses, and I'm always interested in companies like this, particularly when you talks to recession, or you talks of people not having leftover money, how companies like this can actually generate sales. And because for me, sunglasses would be the last thing I would be buying
Yeah,
if I don't have enough cash left over. But over 9 months, they've done reasonably well. You can see that they are direct to consumer, so they're selling directly to individuals, is up 4.3%. Then obviously their optical solutions to professionals is up 3.9%, which gives them an overall 4% growth over the year. Europe again is doing quite well. It's 8% up over the whole year, but Asia is really driving here. It's 15.7. And North America, which is obviously their largest market, is up 3.6. So overall, there's growth in all segments. So they seem to be doing pretty well. What did stand out to me is that they are now going to be launching what they call Ray-Ban Meta. And that's going to be their next generation
no.
of smart glasses. So I wonder how this will play out. But I do know in my line of work, we tried out these like, not Ray-Ban Meta, but we had these smart glasses
Yeah,
that we had to put around our head. And then the idea was that if there was a technician or an engineer on work, and they needed my assistance, they put this on their head, they could look into the machine, and I can see what they could do.
yeah,
It was a disaster. It was awkward. It was hard. You had to have it.
clunky. Yeah,
Yeah, you had to have it placed in a certain way. There's a funny video of me and work actually testing them out. So I'm in the room on my own, and I didn't know the guys outside were videoing me, but like there's nobody around me. I had this headset on, and I'm just pressing tin air
yeah,
like this, no, just pressing buttons.
yeah.
So look, I wasn't a huge fan of them, to be honest, and I'm just wondering what these smart glasses are going to offer you. What are you going to walk around with Google in your eyes?
I don't know. I don't like seeing this stuff in an earnings report. You know, this kind of. I mean, this sounds like diversification. First of all, this should stay in the innovation space and be kind of a footnote in a glossy annual report that they are trying out all kinds of technology. But to put it really already in the headlines of their earnings report, I mean, yeah,
Look, they're trying to push. They're doing something. I suppose you look at companies. They have AI. They have all this. You're developing sunglasses. How can you bring AI into your world?
yeah.
And the first step into that is probably smart glasses, and then I don't know. There'll probably be some AI recognition thing that will help you identify people, or I don't know. But I agree with you. I think this is not an orange sport thing, but it's. I mean, as I said, I just
Well,
don't
they
see a
should
use
try
case.
it, right?
I don't see a use case for this. Honestly, I really don't.
Well, I think there are also enough successful use cases of this. Think about doctors and such doing precision surgery. So there are enough good use cases about it. But what I'm trying to say is like they should innovate. They should try these technologies. These are important technologies that might shape the future. Yeah, here. So they should try it. But what is more for me is like keep it in the footnotes, just that you're working on this, and that is launched. Keep it in your supply chain. Yeah, but not in the 5-6 bullet headlines of your earnings report. I think it doesn't belong there. But maybe I'm just too conservative in this kinds of stuff. But it also triggers me because I remember Pepsi putting in the headlines that they were going to make a game or something like that. I mean, and it was like really considering gaming. And I think like, no, Pepsi, just stick to drinks and snacks. Yeah, and if you want to do gaming, then I don't know, invest in a company that's gaming,
Yeah,
and but stay to your circle of competence.
yeah,
Now here it's of course a little bit closer to the circle of competence, but I must tell, going into the with I said starting this one is a cash burning activity. Yeah, really
yeah,
cash burning, and I think you can better partner with a big tech company and do what they are doing. Use the brand, use the Ray-Ban brand later to stick it on a glass and get your royalties.
yeah, yeah. Well, they do mention Ray-Ban Meta, so partner with someone like Meta who has cash to burn and
Yeah,
introduce it. That's an option. Yeah,
yeah,
I agree with you. Okay, Nestle is another company that released their sales update, their 9-month sales update. And again, sales have decreased. So their sales have been flatlining for almost 10 years here. They seem to be struggling.
yeah.
And what they measure their growth on is what they call real internal growth. So if you read it, it's all this RIG and have organic growth, and then they have
Uh,
prices, and they just use fancy phrases, right? But essentially, real internal growth, it measures how the sales change in terms of volume and product value, and
yeah,
it's calculated from last year's prices.
yeah.
And then it's compared to the previous year's sales. It's really, I don't know, it's really a gimmicky thing, but that's how they measure
Well,
it.
you need to, if your sales is not growing, you need to find something else where you can show positive numbers to your investors.
Okay, and you think that, right? And then you look at their real internal growth, okay, over the last 9
Yeah.
months, and we look at the total group, 0.6, no, minus 0.6%. North America minus 0.9, Europe minus 2.3, Latin America minus 0.6. The only two places that we've seen any real internal growth is in China and their coffee Nespresso, and that's it. So I mean, look, I wrote about them. I think it was in the second
Yeah,
newsletter. Where is the growth going? I'm still struggling to see that, and I was reading what the CEO was saying quite
yeah.
vividly, because obviously these results are bland. And I was wondering, was he going to give us some indication of where growth is coming? Are they doing anything? And honestly, he just blazes over it and just kind of says, we are confident that the combined effect of factors called real internal growth will turn positive in the second half of the year and become a major driver of growth. I'm like, what are you talking about? there's no evidence here of that at all. It's quite disappointing. Look, I think it's a huge company that do have some nice elements to it, but they need a major restructuring, which I know they're trying to do. They're trying to reduce the amount of brands they have, and But
They are just so big that it's hard to make incremental growth. Yeah, they are so big, and we have seen what they've been doing, right? Buying back shares, going heavily into debt for this.
yes,
Yeah, because they are borrowing money to buy back shares. The growth rate of the dividend is effectively almost reflecting the shares that they have been buying back. So this just like you can't say dead money as such here, but people have been funding their growth by putting money from their left pocket into the right pocket and fooling everyone around them with a cosmetic growth, let's say. That's what Nestle is doing. But in the end, the balance sheet is deteriorating over time, which also represents a certain amount of value. And we will see that when the company is under stress. And then if you look at the multiple, like a company of Nestle, and you share me these numbers, it's a slapstick. It's a comedy.
yeah.
It's really a comedy. Who's buying this? Is it just ETFs? Because Nestle is one of the biggest companies in Europe that all these index investors are just buying Nestle here.
It seems to be, maybe it's another case of like 3M. It's too big to fail. It's. I mean, look, as you said, the balance sheet is getting worse and worse. They seem to be funding their dividends and paybacks through debt. How long is that going to last for? We gave it a dividend safety mark of, think, we check quickly, 57, which
Yeah,
is
that's
questionable.
questionable.
Which is
Yeah.
questionable, but it's nearly getting to the unsafe territory, and I
Mm.
think it'll get there quite quickly. I think what has helped them in our in our calculations is that they continue to grow their dividends, even though it's by growth.
64 years of dividend
Do you know
growth,
what I mean?
right? We're talking here about the most iconic dividend aristocrat in Europe, and we are effectively bashing them here on the
Yeah,
podcast.
but
Yeah.
but I mean, you can't get hung up. You can't get hung up on history or get too attached to companies.
Yeah.
'Cause that's
It's
when
true.
problems happen, and you have to call it as it is. So, look, I think the CEO Mark Schneider, he has a lot to do.
Yeah.
He has to try turn this big massive ship around. So I don't see it. They're talking about India, but I don't see any evidence of this in this earnings.
In the
So
numbers.
yeah.
Yeah. Okay. Enough. Let's move on. What is it? Elmo, right? Enough. Let's move on.
Yes.
So let me talk a bit about ASML then,
Oh,
because this is very interesting, right? ASML is the, how do you call it? The shovel of the whole chip industry, let's say. Um, what is very interesting here is that, in my opinion, their margins are a bit better again. Like not too long ago, they got really slaughtered. A few quarters ago for having, I think it was the second quarter or maybe the first quarter, for having poor margins. But their net sales compared to how is it the quarter before have been actually a little bit down. Yes, so this has been a tough quarter for them, so to say. Their bookings are also down compared to the quarter before, and it has a lot to do with just their customers. Their customers effectively are trying to protect cash a little bit. And while the narrative was all the time so far that I said those customers were bringing how I said their bookings forward, right? Because they are playing the long game. I think it's becoming more and more difficult at the moment in the
yeah.
chip industry, and they're seeing that. So they still have a really good gross margin of 52%, which was slightly higher than guided. Overall, I find the numbers relatively good, right? I know they are going a bit through weak quarter now, but what the CEO also said, like here, is the semiconductor industry is currently working through the bottom of the cycle, and our customers expect the inflection point to be visible by the end of the year. I always like it because we always say we can't time the market, but they can somehow. They can say that this is the bottom of the market. I find this very interesting. Of course, I don't believe it. I believe it. I want to see that it was the bottom when I watch in the rear view mirror. Yeah. But they think, and that's very interesting, their guidance is that they expect 2024 to be a transition year because of the recovery in demand. And that's why they are taking a more conservative view and expect a revenue number to be similar to 2023. I don't think this is reflected in the share price yet. I believe the share price is currently at 580 or 540 euro. While of course it was trading about 650 earlier in the year. I still don't think this is reflected in the share price if they will have a flat year. Yeah,
Yeah.
which is very interesting. I said longer term though, they of course continue to expect growth. Now, if you go then into the numbers and just compare the first 9 months compared from last year to this year, they've been growing their system sales by about 5.5 billion. Yeah, their service and field option sales were flat, but they have also been growing their earnings per share from 9.5 to 14.5. This is really, really big growth, like 50% growth in their earnings year over year. But that's why it's so nice that this company is fully transparent. They are not fooling us, because the first thing they do in their headline is compare with the previous quarter,
Yeah.
because they are not hiding the fact that they're having a difficult quarter. They are not masking it. They are not making it difficult for us that we need to go to the bottom of the earnings report to distill it ourselves. No, straight in the face. Compared to the last 3 months, this was a difficult quarter here. I like that. It builds trust in such a company, right? And of course, they have all the time in the news about export controls and such. So I just think that I just feel it's not reflected enough in the share price yet. I hope it will go to the high 400s, and I will be buying and nibbling in then a little bit, because the long-term growth and is there. I saw that Canon is having a breakthrough now, and that they might start doing something to nibble, or to start compete a little bit in the long run. But there's such a moat around ASML that won't go anywhere anytime soon.
Yeah, I find the CEO statement fascinating, particularly as you said when he speaks about the bottom of the cycle, and that their customers expect the inflection point to be the end of this year. That probably means it's going to be pushed on by maybe a month or two. They always try to be a little bit optimistic in these things, but it'll be interesting to compare what he has said here now against what the likes of Intel, what Pat will say, or what Taiwan Semiconductor will say. What will their outlook be? Will it match the sentiment given here by ASML? Because ultimately they have to try and put a positive spin on it, because they're at the bottom, whereas these guys can kind of say it as it is, and give an actual reflection on the market. So it's going to be interesting, and anyone that's invested in semiconductors should probably read this report and then follow on and read the semiconductor that you're invested in, and compare them and see if they match. They should, and if they don't, there's a discrepancy in one of them.
Yeah, but I'm really keeping an eye on this one, because if their sales will be flat next year compared to this year, I expect many opportunities, because at a certain moment investors will see that it is flat, and then they suddenly will come to the realization and maybe extrapolate that also into the future. And we see a lot of bear cases. So not beer. Well, it depends on what you prefer.
Exactly.
But that's why it's so interesting to do. I mean, when you're listening now, do your homework on ASML. Really do it now, because if they are going to have a flat year in 2024 compared to now, you might see some opportunities there that you can buy with conviction.
Yeah, I think this is a no-brainer. This is a no-brainer. I mean, the balance sheet is strong. We give them a dividend safety of 91. It's probably one of our highest out of 100. And look, once they come down into any sort of value zone, you should be buying them hand over fist. But interesting. We haven't yet talked about Johnson & Johnson. We usually open up with these guys. We call them clockwork. Like clockwork is what we say. And they're starting to get interesting again, particularly after their sale or their spin-off, should I say, of Kenvue. So just give you some of the highlights. Third quarter reported sales saw a growth of 6.8% to 21.4 billion. And they're excluding COVID vaccines in all their operational growth, because that has now seen a decline. Earnings per share has increased 4.3%, and they have increased their 2023 midpoint guidance. In terms of where they are, so as I said, their sales grew 6.8%, but what was interesting is their net earnings was pretty much flat from this time last year. We did see an increase in marketing, but there was also some R&D and R&D impairments that they had to pay, and then the restructuring cost then associated with Kenvue attributed to that. In terms of their regional sales, US saw pretty much strong growth. It saw 11% growth, and international, which includes Europe, was pretty much flat. It was 1.6%. So you can see they're really driving sales in the US, and it's been flat over here in Europe. And then if you break it down by segment, so they have their innovative medicine, which is now their biggest segment. That saw 5.1% growth, up to about 13 billion. And the medtech saw actually a decent 10% growth on that. So they're up to around 7 billion. So look, overall there was growth throughout it. And US is obviously where they're seeing pretty much all of that growth.
I'm very much surprised by the growth in the medtech business, 10%.
Yeah.
Yeah, and because I'm holding also a few shares of Medtronic, and Medtronic has been kind of dead money for the last 5-6 years. That's why I have a really small position, because I'm not bullish on it. But if Johnson Johnson is able to grow by 10% year over year, that's a huge number for the medtech industry at the moment. So I'm wondering, where's the sales coming from, in the sense of whose lunch are they eating? Yeah. Or is there just a general recovery in the entire market, and is the market getting bigger? So I will now really look at Medtronics with not having Johnson Johnson in my mind about this 10% growth, because that would be very bullish if Johnson Johnson is able to grow, and Medtronics and also Philips and some of the companies stay flat. Yeah. That will be very interesting. But generally, the market responded quite disappointed on the earnings. I guess it's because the earnings from continuing operations are flattish, 4% up from 162 to 169.
Yeah.
But look, the company is I find the company quite attractively valued from that point of view at the moment. So yeah, it doesn't look too bad, right? Now the yield is relatively attractive, but of course the company is kind of a bond-like investment for people outside of the dividend growth investment community. So maybe again, it's more of interest rates here and such. But yeah, interesting, very interesting earnings report.
No, it's good to see the growth, and we always wondered how they would cope, obviously, with the spin-off of the stability of the consumer staples part, particularly in this moment in time. But when you see those growth numbers, you just think to yourselves, it's Johnson Johnson.
Like clockwork.
You're not surprised. You're not surprised. And you're right. And like in terms of price, at the start of the year, they were at 180. They're getting back down to $150 here, and I think that's buying range for a lot of people. So it looks quite attractive. Okay,
good. So shall I say a few words then about our German SAP?
Yes,
from Waldorf, right? And we were talking about before the show, is like the famous Waldorf salad from the Monty Python, Fawlty Towers sketch.
Towers,
yeah. So they're based in Waldorf. So interesting. What was it? It was like walnuts.
Walnuts, was a grapes,
celery,
and something else in mayonnaise.
mayonnaise, yeah. But I think it's from the Waldorf Hotel, right, or something like that. Yeah. Anyway, look, SAP is also doing a bit of smoke and mirrors here in that sense, because they are putting all the time cloud revenue in our face. From one side, that's good, because that's really where the investment case is for SAP at the moment. But it's you really need to look well about how much cannibalization is going on here, right? With this. So, and I don't like it when I need to look for data like that. But generally, like cloud revenue up by 16%, and it's really now meaningful. Yeah. So where it wasn't a few years ago, cloud is now their biggest unit. And which is really, really good to see, because last quarter, I said their software licenses and support revenue was still their biggest unit, So finally, we can say cloud is the real growth driver here. It's now making 3.4 billion in revenue, and software license, and so let's say the legacy way of doing business is 3.2 billion. So all in all, their total revenue is 7.7 billion now, compared to last quarter 7.4 billion. So honestly, I think we might now start to experience some more proper growth in the bottom line numbers. We see it already. The how is it? The earnings per share were 112 in the last quarter, and now 145. Of course, there are some one-offs here
Yeah.
as well. But I think the share price reflects it, because if you look at the start of the year, the company was trading around 100 euro. Now they are trading around 123 euro. Of course, the dividend yield is 1.65. But yeah, investors could have had these shares below 100 last year if they believed in long-term story. I didn't. I will confess here. I owned SAP for a little while, and I felt like they were missing it on the cloud, not able to transition. But I must confess, they have surprised me. They are doing well now. They are able to really shift legacy business to cloud, which is a little bit more high margin. And I must compliment the company here. They're really pulling it off. What is it? SAP stands for something like everyone hates it, right? This business. So
Yeah,
yeah,
it's one of these tricky businesses that once you're a customer of SAP, you're a customer nearly forever. It's nearly impossible or not worth the time, effort, and money to transfer to a competitor. But yeah, it's good. It's good to see the cloud growth. I do remember you bashing them maybe 18 months ago that you just don't see enough cloud growth from them. And they finally have woken up. And look, it shows it wasn't too late for them. They were just biding their time. But it's good to see actually their cloud revenue is probably their biggest revenue now at the moment. So it is getting quite meaningful for them. So and a business like them should be pretty much all in the cloud, really.
yeah.
So yeah, look, fair play to management, and any investors that bought them under or close to 100 as well did quite well out of it.
Yeah, and I think SAP stands for Start Applying Patches. And I believe, how is it? The thing Killing Me Softly was actually originally written by a SAP customer.
Oh, I love it. Okay, quickly one more, and then we'll roll on to some questions. I had a brief look at Snap-on. I know we get a lot of questions around Snap-on and Stanley Black and Decker and who's better and all this, but
Snap-on, of course, is better.
yeah. These guys, I don't know how to do it. They just seem to continually grow. Their net sales for the quarter reached 1.15 billion, which is a 5.2% increase over the previous year. Remember, this is just tools. These are all like your tools for cars, pretty much automotive. I just find it crazy they can grow this much. They said their commercial and industrial group grew 3.2% because there was an increase due to higher activity with customers in critical areas. The repair systems also grew 3.1%. And what's interesting is that was driven actually by independent store owners for diagnostic and repair information. And then their overall group grew 3.7%, both internationally and in the US. So they're actually doing quite good for me. Their net earnings was actually up from 4.51 per share to went up to 4.51 from 4.14. So some decent growth. They are actually reinvesting. So I think they've spent 73 million already in R&D, and they're going to invest a total of 100 million this year. And they're looking at opportunities outside of the automotive repair as well. So look, it's a quite interesting company. I was just looking at the share price though. It's still not at a price that's interesting enough for me. It's around 250. I think under the 200 mark, I think is where I want this company to be.
Me too. But such a well-managed business, right?
Oh, it's fantastic.
Pristine balance sheets.
Yeah.
If you compare this to Illinois Toolworks, which is just like much more leveraged than, Snap-on hand over fist.
Yeah, I mean, these guys, like their tools are not cheap, but it's the brand, it's the power, they do really well with their sellers and getting involved with independent repair shops and independent owners. And
Yeah.
kind of when you become a customer, it's like Snap or SAP.
Yeah.
When you become a customer, SAP. When you become a customer, you kind of stay with them because the quality
Yeah.
is so good.
And I remember the first time this company was being brought to us on the podcast, we heard the term tools and Snap-on. We felt that this was the strap-on company.
I think I actually think we spent that whole episode um, making
jokes.
making
Yeah.
fun and making fun of the company. And then I think maybe 2 or 3 people afterwards say, "Hey lads, come on, look at the company, look at it." And then we did, and it turns out it's a very solid business. But look,
Yeah.
it's a company it's a type of company I would love to own, particularly around the management and how they manage that. But price is obviously important.
We should have spent time researching the company at the time, because at that time it was trading around $200
It was,
instead of making fun of it.
yeah, I think it was even under $200. So we could have been shareholders now, but hey, that's shame on us. Shame on us.
Yeah.
Okay, let's move on to some questions. I think we have quite a few questions to get through, so we'll do our best to answer them. And we'll start with Paul Matthews, and he's asked us, do you think that there is now value in UK and European dividend growth stocks, seen as the Fed is so hawkish and that many US stocks are in a high valuation bubble?
Honestly, I don't really know. I think over the last few years, Europe has been generally behind in multiples, but I also felt they were always realistic, and I felt like the US was just a bit inflated. So to his point, I think nothing really changed. But if you're interested in share price and you're afraid of share price decrease, yeah, there's maybe more to go down than if you think logically with US stocks. But again, I always say it's a market of stocks, not a stock market. So, for instance, I find Johnson & Johnson not in bubble territory as an example. Yeah.
Typically, you're correct there. Europe and UK do trade a lot lower than the US. And look, with them being so hawkish and interest rates going up, there is opportunities in Europe. We've talked about some good companies there that we talked about L'Oreal and ASML, where there's probably not so many opportunities, but you can look at a company like Schneider, Ahold Delhaize, Siemens, even for example. There's definitely opportunities here. If you go into the UK market, it seems like they're all on sale. Honestly, take your pick there. Some really good companies on sale.
What do you think about Ahold? Around 27 euros right now.
They're getting, like, I'm price anchored at around 25, but honestly, I might start nipping in at them again. I have 100 shares. I would like to increase that. Such a good company, and they come out well on our safety score as well. So it's a company I'm definitely interested in increase my position. So 26, 27, I might start dipping in and out. Okay, the next question is from Adam Bacon, and he has asked us, do you drip directly back into the stock that paid a dividend regardless of the current valuation, or manually reinvest your dividends into other stocks that look more attractive?
But let's say it's really simple. In Europe, we don't have too many opportunities to do drip. So wherever I can, I turn it on. As an example, on Interactive Brokers, I can drip on Shell and Unilever as example, and I keep it turned on there because the companies are not, for me, richly overvalued. Of course, historically, you could say, like, when Shell is at this level, you can expect the peak in the market. But I just like the feeling of dripping there. But reality is that for most of the stocks, I just collect the cash and add it to my monthly investments. Not so much by choice, but just by it being the only option.
Yeah, I'm similar. As I said, the gyro don't allow you to drip anyway. So I have a lot of companies there that I can't drip on, and I don't have it turned on in Interactive Brokers. Usually what I will do is, with a company, if I want to reinvest it in, I probably don't have enough for the full share, but I will just put the extra money to it and buy some shares of that. So yeah, it's just a feature. I didn't know. Can you do it with all companies on Interactive Brokers?
No, just the UK ones,
UK
because
ones.
I think I'm with the UK Interactive Brokers.
Okay, yeah. So that I would be the same. It's based in Ireland, so probably just the UK one. So yeah, no, I don't drip back in. Just reinvest manually, I'm afraid. Josh has asked us if you were setting up a non-US dividend portfolio with about 60K starting next week with the objective of setting and forgetting it, how would you allocate that money?
From the 60K, if I would also be, I said, so it's non-US dividend portfolio.
Yeah.
I would this is a difficult one. I would not buy everything at once. I will probably put it in chunks of 10K per month, and I will probably look at some of the best quality dividend aristocrats simply. I wouldn't put in ETFs because we don't really have good ETFs unless you want a 1.5% yield, which I think is not needed. So I would mix up a little bit of ASML with British American Tobacco and such, really to do that. But I would also think about 4 or 5 stocks that I want to be the anchor. Probably something like Ahold Delhaize would be in there. Maybe actually still some Unilever also, although the dividend has been flat. But I think it deserves a bit. You need some consumer staples in your portfolio here. But also insurance like NN Group, I will probably try.
I just did a quick thing there. I ran a quick screener on, I think we have about 100 stocks, and some of them are in my portfolio, of 3% dividend yield and a dividend safety score of safe or above.
Yeah.
And top of the list is 1, 2, 3, 4, 5 European/UK companies. They're the top 5. So Ahold Delhaize comes out at number 1. Greencoat UK Wind, it's an investment trust about renewable energy, comes in at number 2. Roche is surprisingly, Roche Holdings comes in at number 3, followed by Unilever, and then another one that I have is Murray International Trust, which is an investment trust that has a dividend growth strategy. It's a really interesting investment trust. So I would honestly, if I was to pick out of that, I would probably pick the Wind, Ahold Delhaize. I do like to have some Siemens. ASML would have to be there, and then on top of that, British American Tobacco for some high yielding as well. That's probably where I would start looking. So we've given you loads of companies there, so you can surely pick 1 or 2 out of that list.
Nice one.
Marek has asked us, what is the longest time you didn't log into your brokerage account?
Oh, I don't know. I need to buy every month, so it must not have been more than a month.
Yeah, mine is pretty much monthly. I get notifications of when I get dividends, so I don't even have to log in to check them. So yeah, probably a month. Hugo has asked us, ever considered investing in a company with a pristine balance sheet, no debt, low goodwill, and they have fairly reasonable profit and loss that plays a flat quality dividend for the last 5 years, and let's assume around a 5% dividend yield?
I've never considered it because I don't know such a company, because usually companies with pristine balance sheet are able to grow their dividends. Let's take a look at T. Rowe Price. Yeah, it's very cyclical here because their sole metrics is assets under management. They've been able to grow the dividend through storms, through summers, whatever it is here. So if it's a hypothetical question, I probably not, because I would be concerned that if they can't grow the dividend while they have a pristine balance sheet, there must be a cash flow growth issue.
There is one company that is like that, and I can't remember their name. I think it's a ticker symbol MLI, Muller Industries. I think their dividend policy is just to pay a flat dividend, and that's what it is. But they are a well-run company. So I wouldn't rule it out. If you know that their cash flows are stable and you're guaranteed a 5% even without growth, it's probably nice to have one company that you can count on their dividend no matter what it is, even if they're not going to grow. I don't see any harm in that. And if they're a growing business, even if they're not growing the dividend, you will probably see some price appreciation that maybe you benefit from. So look, I don't particularly see a problem in that, but I think as European DJI mentioned, we follow a dividend growth strategy, and the growth is important. Because yes, we start now with a 3% yield and maybe a 5-6% growth rate, but we're looking for that to hit 6 or 7% in the future, and
Yeah.
they can only do that by growing their dividends. Um, Joris has asked us, his girlfriend who works at Shell told him multiple times that she got company shares as a bonus. I didn't pay too much attention to it until I found out it was quite some amount. With those shares, Shell is now instantly 30% of our portfolio. The average buying price is around €20. Any advice on what to do? Sell a large part or keep it?
Oh boy. I mean, I'm not going to give advice on this one because I said this is so personal and it's related to someone's stock purchase plan. But I can tell you what I would do. If it would become 30% of my portfolio, knowing where the price is today, I would probably just make use of the opportunity to sell some shares. Yeah, and because 30% in one position in a cyclical company like Shell does sound too much. This is not like Warren Buffett and Apple, yeah, where it's such a strong consumer brand. It's not. So I probably would pull a bit down. I also assume that when they get shares in Shell, that these are as a result of options or let's say share discount purchase programs here. But yeah, it also depends a lot on how you envision your portfolio in the future. If you're just a starter and it's now 30%, yeah, that's something totally different than when you're already like in a mature portfolio.
Yeah. For me, if I got those as a company bonus, I didn't have to spend any money to get them. A company like Shell, if I'm happy to hold them, I just would keep them. I wouldn't bother. I wouldn't bother selling them, honestly. But that's just me. I would never tell someone what to do.
Yeah.
Obviously, 30% of your portfolio is quite large, as well. So look, there's a lot to consider. What does your girlfriend think? Does she think 30% is too big? So maybe have a chat to each other and see. But personally, if I was just buying those, if I was being giving those shares as a bonus, I would be happy to hold on to them. I'm not losing any money from them. That's the way I would look
Yeah.
at it. Kieran has asked us, do you budget for any known expenses across the year? He keeps money aside for holidays, presents, cars, etc., etc.
Yes, of course. Of course. Yeah, I do. I mean, that's the whole thing, right? You first need to make sure all your high debt is paid off, that you have your expenses in control. And expenses doesn't mean only looking at running expenses, but yeah, you have those one-off expenses that are once a year. Yeah, you need to reserve a bit of money for that because I don't know about you, but I cannot pay a holiday just like that out of pocket based on a monthly salary. No, I need to save up a little bit for that. So yeah.
Yeah, I think it would be a little bit irresponsible if you were to invest all your money and not have anything left over for holidays, presents, or cars.
Yeah,
So I think you do. I think you do have to budget, particularly if you have a family. You have to sit down. You have to consider
yeah,
their needs. What do they need? What do they want? And then
exactly.
invest what's left over. Tim has asked us, do you have a strategy for averaging down when quality stocks that you own are dropping?
Yeah, definitely. I just buy them. Yeah. So, but how to say it? This comes again with doing your homework up front, knowing what to own. At the moment, just like that, my strategy is mostly trying to convince myself buying more high quality companies and not fall into the yield chasing mindset. Because there are some companies now at like if you look at an N group with a 9+% yield, but I also so what's really important with DCA that I not buy all at once. Yeah. So I have some thresholds in place that I don't want to buy so much of a certain company all at once because you might be wrong. And I've caught falling knives in the past. So I built my system like that I don't get hurt too much when I'm buying a falling knife by, for instance, not allowing myself to buy more than once a month.
Yeah.
And then once it's already a tier 4 position, like with a certain volume, then I just shouldn't buy anymore this year and just let it on the shelf. And that's what I've been typically doing.
Yeah. I think it's easier to buy if there's a reason for it, like a black swan event or the whole market is down or something
Yeah.
happens. But if that one quality company you have is trading down on its own for no reason, or maybe there is a
Yeah.
reason. Let's think of 3M, for example.
Yeah.
It becomes then a lot more. You have to think about the reason why you're averaging down. But
Yeah.
once it happens, like as I said, black swan or whole market is trading down, I have no issue with it. But if there is
Yeah.
a reason behind it and it's only your company trading down,
Yeah.
a little bit more research would be needed.
No, I give you a good example. I've been buying a lot of T. Rowe Price late last year and begin this year.
Yeah.
Yeah, and now, even though the price is coming to the 100, it looks very attractive to me. But I'm just looking at the amount of value I bought already this year, and I think like, yeah, okay, just enjoy the fear of missing out a little bit more. Although my inner devil is saying buy, 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 buy.
Yeah.
Yeah.
Mac has asked us. He uses a DCA strategy, but at the moment, he has some significant additional capital to invest. The market looks like a candy store, and I'm wondering whether to stick with the strategy or throw that capital in right away. So again, look, I'll tell you what I would do. I would always stick to my strategy, which is the dollar cost average. And if I had additional cash, which I did maybe this time last year, what I did was I put a little bit extra in when I was dollar cost average, and that's pretty much how I handled it. I didn't throw it all in. If you have a really solid conviction and there's definitely one or two companies that you want to own a large amount of, by all means go for it. But personally, I would stick to my own strategy and just add a little bit in as I go along.
Awesome.
Hugo has asked us about Coca-Cola, ticker symbol KO. It was mentioned a few times that it now has an attractive yield, but we only ever mentioned the US company. Would you ever looking at the UK or Netherlands-based company? And with the UK stock, there would be no withholding tax at source.
I can't imagine that, because usually you pay the dividend tax at the country's legal entity, which would be the US. So I would still expect for the UK listed shares to pay the 15% dividend. Yeah, I'm not familiar with Coca-Cola if there's something special there, but I always thought like you pay where and we see this, for instance, with UK listed stocks like CRH from Ireland. You pay the Irish tax rate. That was the 20 or 25%, not the 0%. So I would expect the same for Coca-Cola, but unless there is something special there between the UK and the US, then maybe, but otherwise, no. And why not? Usually there's lower liquidity in the market there. So if there's something happening and you want to get rid of your shares, it's usually more difficult for me.
Yeah, the no way holding tax is not a factor for me because I still have to pay tax. And actually, it's easier for me if it's taking at source because I have to file it then and so.
Yeah.
So I honestly, it doesn't bother me about the no way holding tax. And look, I'm not sure whether you do or don't pay withholding tax on them. I'm trying to think with someone like British American Tobacco what way it is. But look, I don't know. But it's not a deciding factor for me because I still have to pay tax. And I'm happy to own the US one. I have a lot of exposure to the US dollar anyway, so one more company is not going to kill me. Paul Matthews has asked us, do we have any thoughts on Lowe's or Home Depot?
I mean, I like the businesses. Home Depot has been on such a fire over the last few years, right? And at a 2.9% yield and a 17 PE, it looks really attractive. Yeah, I also am looking at Hornbach, the European equivalent sometimes.
Yeah.
I think Home Depot is a better managed business, but my issue is here a little bit is I don't understand Americans and how their housing market from that point of view there. I know that they don't really use bricks to build a house, but mostly wooden panels. So maybe that's why there's a lot of future in Home Depot. I have no clue.
Yeah.
So, but look, maybe I should do some proper research into it and make myself more familiar with Home Depot because its growth rates has been stunning.
Yeah, that's true. I was about to say that the growth rates are pretty impressive, but I haven't done my homework in either or two of these companies to make that sort of decision. To be fair, Ronye has asked us from his desired portfolio, he is missing Munich Ruck, Allianz, and Walters Kalua. They are climbing and climbing far from his fair value calculations, but he's ready to bite the bullet and DCA into them. Which one of these would you prefer to start with?
Walter Kluwer. I'm really impressed with this boring business, and they're a cash flow machine.
Yeah, I would be the same. Allianz is quite good, but again, it's cyclical, so I'm pretty sure that would have a better chance of coming down to your fair value as well. But I would say if they are really, really, really far away from your fair value, maybe just have some patience. Wait, who knows what happens?
Exactly.
You have other companies in your desired portfolio that might be attractively valued as well. So think of Warren Buffett owning companies at a fair price, quality companies at a fair price. Bruno has asked us our thoughts on the latest ASML, Roche, and AXP earnings. I think we spoke about ASML. I didn't look at AXAP and Roche. I just quickly glanced over the main headlines. I haven't looked into them, but it looks like pharma again is performing quite strongly, 9% growth, and diagnostics then is up 7%. So it looks like actually their sales have been going pretty well. COVID-19 sales is actually down about 4.5 billion, which is a lot. And there's also some biosimilar impact to AHR, which cost them about 1.1 billion. But from a sales point of view, look, it looks pretty similar to the last two quarters. It looks like pharma is driving growth, and diagnostics is actually not too far behind.
Good.
Fabio has asked us, what's the best REIT ETF for diversification and safety for Europeans?
I'm not familiar with REIT ETFs, but I would never ever buy one probably here because I don't trust the European REIT ETF sector as a broad basket. I trust some individual companies like Defama as an example that I have in my portfolio, a small cap, but no, I would not touch a REIT ETF, and not if you want dividend growth.
Yeah. I'm not sure of European ones. There are some investment trusts. I think I mentioned Murray International earlier that do invest in European REITs as well. So I prefer to stick to those. And last question goes to Morpheus from the Matrix. He's asked us, please give us your thoughts on LMVH, their earnings and outlook.
Yeah, so LVMH is very interesting because people didn't really like the outlook that the company is going, and the company also went a bit down because of that. So look, let's stick to the facts, right? They have grown their business in the first 9 months in sales with 10% reported and organic 14%. It went from 56.5 billion to 62.2 billion. Every division generally has been doing well except for the wines and spirits. Yeah. So and specifically, I said the selective retailing business grew by 2.4 billion, but also their fashion and leather goods grew by 3 billion. Really amazing results, I would say. Of course, it's maybe a bit of a slowdown compared to what analysts had expected, and they grew 17% in the second quarter. So look, there's definitely been a slowdown in their growth numbers, but this is still a high quality company. And I said what the chief CFO said is that after 3 roaring years and outstanding years, growth is converging toward numbers that are more in line with historical average. Well, that's good. Maybe we get all those people that are thinking that the stock is going to the moon washed out, and that LVMH becomes a stock again that can be owned by dividend growth investors. So the last thing is like they do expect, I said, some more headwinds because the economy is uncertain, geopolitics is at play. We all know what's happening again with the wars here that are coming closer and closer to mainland Europe. So for me, it feels like a little bit all overdone and might become more like an opportunity to investors.
Yeah, when you have growth rates like they have over the last few years, and the share price accelerates, it's only natural that when you start reverting back to the mean, that the share price will follow through with that. So look, I think if these guys get down to around 400, they might start becoming a little bit more attractive for me. They're still a little bit richly valued, but they are, I mean, they are a good company, to be fair.
Well, let's say like that, right? The PE ratio, I think what I see in my data is here like 20.
Yeah.
But they were of course touching 900 like in July. Yeah, so just a few months ago. It's been just a downward trend, but year over year the share price is still 5% up.
Yeah, that's I was
Yeah,
looking at the same thing. I'm looking at the share price just before the pandemic, and it was around 400 or 360 and 400,
yeah.
and then dropped to 360. So that's around the price range I would like to get it at. But
You're anchored at the COVID low.
yeah, not it's above the COVID low. It
Oh,
dropped.
okay.
Yeah, it was
Okay.
400, then dropped to 360. But I think,
Yeah.
I mean, I think a company like this is good. And you look at the growth rates. I mean, if you didn't have those 3 years of really strong growth, and you looked at these numbers, you would say, wow, they're pretty good.
Exactly.
So
Exactly.
you have to keep it in context as well.
Yeah. I find the company at the moment, if you want to nibble in, it might be an attractive price here. Come on, a 20 PE ratio for a company like LVMH, and a 1.9% dividend is not too bad. But people need to remember they cut the dividend also during COVID. So this is not, it's not a safe dividend grower from that point of view.
Okay, so I hope that answers your question. Again, thanks to everyone for all your questions. Really do appreciate them, and thanks to everyone who voted in the poll as well. It's a really busy week. Next week is probably going to be the same. There'll be more earnings. If there's anyone you want us to look at, please let us know beforehand, and we will do our best to get to those in the show. So from both of us, we will see you all next week. Remember, both of us at Dividend Talk are not certified financial specialists through formal education. We are just two guys sharing our journey for inspiration and entertainment purposes. Hence, this is not investment advice. Although we do our best, we can't promise that the information discussed is always correct, nor appropriate for you or anybody else. We always recommend that you do your own due diligence and be accountable for your own choices. As we always say, you can't borrow conviction from others. Last but not least, by listening to our podcast, you agree to hold us harmless from any ramifications, financial or otherwise, that occur to you as a result of acting on information provided in this podcast.